Hey guys, and welcome to the Money Podcast. You know, we hear a lot about how your portfolio should have both stocks and bonds because they typically move opposite to one another. The theory is when stocks go down, bonds should protect your principal. The problem, every once in a great while, stocks and bonds both tank. For example, this year, 2022, as of May 10th, the S&P 500 is down 15%. At the same time, rising rates have crushed bonds, with some long-term bond funds down 20% or more. So what the heck are you supposed to do when there's nowhere to run, nowhere to hide? Let's find out. I'm Stacy Johnson. As usual, my co-host will be financial journalist Miranda Marquit. Hello, Miranda.
Hey, Stacy.
Listening in and sometimes contributing is our producer and novice investor, Aaron Freeman. Hey, Aaron.
Hey, guys.
And this week's special guest is David Stein, a former hedge fund manager and the author of Money for the Rest of Us. Hey, David.
Hi. Good to be here.
Thanks for being here. We're going to get the ball rolling, but first, a quick disclaimer. Should we discuss specific investments in this show, do not take them as recommendations because they're not. We don't know you, so before you invest in anything, do your own research and please make your own decisions. Let's get back to the topic at hand. Before we get into this, David, would you briefly introduce yourself? Tell us a little bit about yourself, your background, your business, and what you do.
Well, certainly. Well, foremost, I'm not a former hedge fund manager. I'm a former institutional manager. So we managed assets for endowments and foundations. So, and I did that 17 years and left that, sort of retired early in my mid-40s and launched really investment education, working with individuals, not in an advisory capacity, but just providing education on how investment markets work, financial type topics. And I do that through our platform as Money for the Rest of Us. We have a podcast and also an education platform.
And it is an awesome podcast. But, David, I'm sure you will agree with this, although you probably won't say it as vainly as I will. But I think I know more than about 75% of the people that are here doing podcasts on money. And then there's 20% of people who know as much as me, and there's 5% of people who know more. And you were in that group. You were brilliant.
Well,
really.
We'll see during this interview.
Yeah, I just set you up for failure there.
Exactly.
No, but you really do know what you're talking about. I was listening to your podcast just this morning, which I'm going to refer to again shortly about the bull market in, what am I trying to say, commodities. And that was a great podcast. And I would recommend anybody who's serious about investing to listen to David's podcast. They're awesome.
Great, thank you.
So David, now that I've set you up as a genius, let's just say first that when bonds and stocks go down together, it's very rare, and it usually has to do with inflation. Is that true?
Well, it has to do with inflation, but also has to do with the fact that interest rates are going up. So mathematically, if interest rates are going up, then bonds fall. And we're in an environment now where the Federal Reserve is raising its policy rate, trying to fight inflation. And that is causing what we call long duration assets, or more interest rate sensitive assets, to fall. And within the stock universe, the most interest rate sensitive stocks are growth stocks because they don't pay any cash flow. Many of them don't pay dividends. And so they have this higher earnings growth going out in the future. But mathematically, if you're trying to figure out the intrinsic value of a stock or its fair value, if it has more cash flows out in the future, as interest rates go up, it's going to be worth less. And that's what we're seeing. There's elements of the stock market that have been, they're down, but not down 24% like you're seeing with the big cap growth stocks. And those tend to be more value oriented stocks that pay a dividend. And so they've been somewhat protected from this downturn. But at the end of the day, it's because interest rates are going up, and they are going up because central banks are raising short-term interest rates, and that flows through the entire yield curve or longer-term rates.
Now, I'm a Social Security aged investor with a lot of money in the stock market. I own a lot of FANG stocks. You used a different term on your podcast, David. It wasn't FANG; it was something else.
Oh yeah, it was FanMag, which is
yes, FanMag.
And I don't ask me to tell you what every single name in there, okay. But the idea, the concept was, we come up with these acronyms, the FANGs of Facebook, Alphabet, Netflix, and then when one of them stumbles, then they have to change the acronym again. And so FanMag was basically big cap technology stocks and how well they had done up until kind of late 2021 when the environment changed, and you're seeing the large cap growth stocks have gotten crushed in this market.
So what do I do? I've got a lot of those, and I've made a ton of money on them too. Some are in my retirement account, some aren't. What should I do?
Well, down markets are a great time to make sure you don't have too much stocks. And so the stock market, worst case scenario, can fall 60%. So you mentioned the S&P is down 15. We're not even close to a worst case scenario. So this is an environment to say, if you're near retirement or you're in retirement and your lifestyle is going to be impacted by a 60% decline in the stock market, then you have too much stocks. So when somebody is at retirement age or approaching retirement, that's the time where they need to have some cash flow, some income, some dedicated income sources that are not dependent on the vagaries of the stock market, because we don't want to be dependent on the stock market for a successful retirement when we're actually retired.
Yeah. Unfortunately, I've been reduced to having to do a podcast to try to bring in extra money so I can survive.
Well,
it's a hard life. It's a hard life.
It's a good thing that's not true, because it sure as hell wouldn't keep anyone alive.
Yeah, I know what podcast margins are like. Yes, there are better business models than being a podcaster.
Yes, but it is easy and it's fun. So would your advice be essentially, if you're my age, if you're in your 60s, time for a gut check and maybe take some money out of the market. But what about if you're Aaron's age or Miranda's age in their 40s, or you, I assume, too? Is this just time we put on our big boy pants and just get used to the market going down for a while, or are there things that we could actually be doing?
Well, it's a chance to look at what type of stocks you have. So I feel more calm about this market downturn than I did in 2020, because it was a very different environment. 2020 was the economy was shutting down. We had an unknown virus. It was contagious, and we had no idea what was going to happen. This environment is the economy isn't slowing, it definitely isn't contracting, and there aren't even signs of an imminent contraction. And so I know in my portfolio and what I'm recommending to members of Money for the Rest of Us is, barring you had too much to stock to begin with, now's the time to be patient, because if you are in value stocks, if you have hedged equity, in other words, you're protected against weakening foreign currencies as part of your international allocation, and you have dividend paying stocks, and you had less interest rate sensitive bonds, then you're fine. You ride it out. Your portfolio is down maybe 10, 12%. That's normal volatility. And the challenge is when you look at 2008 or 2020, when there's an economic recession, a global recession, that's when the market tends to fall even more, even to a larger extent. And
are you looking for a recession here?
No, in the sense that, I don't predict recessions, and the reality is everybody's lousy at it, and you would think the recession was going to happen tomorrow, based on, one of the things we monitor is investor sentiment. And investors are incredibly bearish, and everyone is expecting this recession because the Federal Reserve is raising interest rates and they think they're going to overdo it. Maybe they will. But when the Fed raises interest rates, it can last 3 years as they raise rates. And certainly 6 out of the last 8 times that the Federal Reserve was raising interest rates, it ended in a recession. But those recessions weren't necessarily because the Fed was raising rates. The recession in 2020 was not because the Federal Reserve had started raising rates in 2018. It started because, or actually I believe it was 2016 they started raising rates. So we were 3 years into the Fed raising interest rates, and then we had a pandemic, and that's what killed the economy and caused the stock market to fall. So the fact that the Federal Reserve is raising rates is in some ways a good thing. We have inflation because people are out buying stuff. Airline fares are up 40% in the last 3 months. And that goes into the inflation number. And why are they up 40%? Because now everybody wants to go travel.
Yeah.
And so we just have to kind of ride it through. And if the risk of a recession increases, then at that point, maybe we pull back some risk, but not in this environment.
I'm thinking the market's going to go much lower than it is now. Actually, this morning at least, the S&P 500 was basically right at 4,000. And I would be surprised if it didn't go down another 300 points. And because we haven't even started raising rates yet. And the economy sooner or later will contract, whether it goes into a recession or not. Good for inflation, but I can't think it's going to be good for stocks.
Well, the economy will slow, right? I mean, it'll naturally slow, but that doesn't. It all comes down to what's priced in. I mean, we'll always get a recession. There's always a next one, and that's where I kind of take issue with those that are out predicting doom and gloom all the time. And not that you're not. I'm not saying you are, but others that's kind of their shtick. They are always out predicting the next bad thing, and eventually a bad thing happens, and then they pat themselves on the back.
Yeah.
Meanwhile, and so I'll just wait and see. But right now, if you look at business survey data, their debt balances are low. Generally, they have cash. Consumers have a boatload of cash from all the stimulus over the last few years and the high savings rate. And so they're better positioned now for an economic slowdown than they were, let's say, back in 2007, 2008.
And that's a good point too that you bring up. That not all recessions are the same. Like the recession that we had because of and you mentioned this because of COVID was sharp and short. Mm-hmm. The recession that we had in 2009 or prior to 2009 was horrible and long. So I'm feeling like there may be a recession in the sense that there's going to be shrinking GDP for a couple of quarters, but I don't think it's going to be a prolonged recession. Of course, a nonsense statement to make since I can't predict the future, and there's a lot of outside influences going on here, like the war in Ukraine, for example, or the supply chain issues that we have that could either exacerbate or mitigate any potential recession. So it's really hard to know.
Well, it is. And so what we can do is look at the level of bearishness among investors and how many are talking about recession. And so if everybody's talking about it, expecting it, then it's usually already priced in to financial markets.
Makes sense.
And then we just need a little bit of good news, and then you could see things take off. But we don't know. Go ahead.
Oh,
I was just going to ask Miranda what she thinks.
Yeah. So, I mean, I think you do need to just figure out where your portfolio strategy is, figure out where you're at with your own goals and kind of go from there. I mean, we don't know what's going to happen. We just did an episode on when do we think a recession's going to hit. We did bad things and tried to predict things. But really it comes down to figuring out, okay, what are my life goals? How is this going to be impacted by what could be coming? And how do I stay on track with that? And I mean, for me, as we know, boring as always, I just keep on dollar cost averaging into those index products because whatever happens in this next crash or this next slowdown or this next recession, whatever happens, I'm going to get through it, and I still have at least 20 years before I need the money. So I don't know. I don't know if that helps anybody.
I need mine in 20 minutes, not 20 months or 20 years.
Then you should probably be doing things that are different than what I do.
Yeah, well, the big difference between us, and I'm sure this is true of people listening to this podcast, Miranda is an investor in index funds, and I'm an investor in individual stocks. So when you and I talk about FanMag, I own these stocks. I can sell them. I can buy other stocks. I can buy consumer staples, for example, and things like that to help offset any potential declines in the market. But people who, like Miranda, who are just investing every month, or Aaron, they're basically, their strategy should be relatively simple, which is just be patient. Do you agree with that, David?
I like their approach better than investing in individual stocks in the sense of
yay, we finally have somebody on to sort of agree with me.
But that's why you invited David on this podcast, isn't it?
It's right.
I just realized that.
But let me tell you why. And by index funds, so I'm primarily a passive investor, but I also have active funds, and I have over a dozen different asset classes. And so I think one of the challenges with index fund investing is people will buy one index fund. they'll buy the S&P 500 index fund or the VTI, the Vanguard Total Stock Market Fund. And so there they are. Their equity is 100% in U.S. stocks, and they ignore 40% of the rest of the world, which has higher growth. And so I think I like to buy index funds or ETFs because it's baskets of securities, and I don't have to predict which one is going to surprise to the upside and which is going to surprise to the downside. When you buy an individual stock, and I spent 17 years researching hedge fund managers, researching stock managers, trying to understand, their process, and I came away disillusioned in the sense of they're not very good because they know a ton about these companies, but inevitably something happens that they didn't expect. And when we buy an individual stock, what we're saying is the consensus is wrong and we're right. The stock is going to do better than what everybody expects. And as long as people understand that's what you're doing, because think about Netflix that fell 40% in a day. Why? Because it did much worse than what everyone was expecting. And then it got crushed. And so the way that I think, Stacy, you're approaching individual stocks where you go into different sectors or things like that, that's a more sophisticated way. But just sort of naively buying a stock, a FanMag stock, because it has high growth isn't a very good reason to buy a stock. It has to grow faster than what everybody expects and what's reflected in the price.
That makes sense. And, I want to ask you about specific ETFs because I was listening to your podcast this morning, like I said, and you mentioned a couple that I want to ask you about because I'm very interested in them personally. But what I have to do first, though, is take a really quick break so we can pay the bills. We're going to come right back and we're going to talk about specific things you might want to try in the environment that we're in today. Be right back. Okay, we're back. And David, I hope I don't put you on the spot because you mentioned a couple of ETFs that would do well in inflationary environments. And actually, specifically, you were talking about a commodity Super Bowl, what's it called? Super cycle.
Right.
Yeah, of commodities. Yep. And you said in that podcast you weren't sure whether that was going on, but this is one of the things that is happening that we can even our most novice investor out there will understand is that inflation is having a positive impact on some commodities like oil, certainly. And you mentioned in your podcast about the electric car. The electric car is going to become a huge thing in our future, and there are minerals that are involved in the production of those cars. So first of all, this was only a couple of weeks ago you did this podcast, but do you think we are in a commodity super cycle? Is this something we can do to hedge the falling stock prices we see generally?
Well, it is the one investment that has worked. So commodity futures are up 30% year to date. And so if you've invested in it, you can pat yourself on the back. Commodities are challenging because it's a zero-sum game. So just like with stocks, with commodities, when you buy, and you're probably referencing, for example, the Deutsche Bank Commodity Tracking ETF. So DBC is an ETF that I've invested in the past. Our institutional clients have invested in it. I don't currently own it, but that is invested in commodity futures. But a future contract basically has priced in what the consensus of what oil prices will be in the future. And in order to make money with an ETF like that, oil has to have a higher price than what's already reflected in the futures contract. Otherwise, you won't make any money. And so investing, it's very important to understand, what does it take to be successful? And when you're investing in commodities, what it takes to be successful is inflation has to come in and surprise everybody and be higher than expected, because that is what has happened. And that's why commodities have done so well. If inflation comes in lower than what is expected, and then you'll see commodities sell off, and then it won't work out so well.
Yes, and just today, as a matter of fact, the CPI came out and had inflation a little bit higher than expected. Well, depending on how you measure it. But at any rate, oil is up today, though. So here's my question, though, David. Would you advise people at this point, it is May 11th, 2022, would you advise people to look at an ETF that benefits from either rising interest rates or rising commodity prices or both? rising inflation? Because you also mentioned an ETF on your podcast that benefits from rising inflation. It invested in stocks, not commodity futures. I can't remember what the ETF was.
Right, it's the Horizon Kinetics Inflation Beneficiary ETF. INFL is the ticker. That particular ETF, I like better than commodities because in that case, they're purchasing companies that will benefit from higher inflation, but they don't need higher inflation for the investment to be successful. So they own land and they own royalty trust and things that benefit from that. Whereas pure commodities, I don't own because it's probably the most overextended bullish trade out there. Everyone is bullish on commodities, which means it's reflected in the price. And there's some good arguments for why commodities might not do as well, in the sense of the Chinese economy is slowing, and ultimately it's a supply and demand thing, and that's where if enough supply steps up and demand slackens, and commodities will fall, and we just don't know. And I don't like to take binary bets in the market. I want to get paid cash flow, which you don't get with commodities, but you do get with other investments that can be protection on inflation, real estate, for example, or things of that sort, dividend paying stocks, and benefit that way.
So, Aaron, we haven't heard from you at all. Do you have anything to say? Because I don't want to interrupt you if you have some thoughts.
Well, you guys haven't talked about the bond element here yet, and that's my question. So usually bonds and stocks are inverse with each other, and this time they're both down. And from what I'm reading, a lot of it is that these companies are cash flush and they don't need any money. And there's different types of bonds out there. There's junk bonds and mutual bonds and all kinds of other things. At what point do people jump into those things? And every time I go on and I read something about bonds, they always seem risky. So can you guys clarify or clear up, what will bonds do in the future, or what's a good time to get in? What type of bonds you should get into?
That's a really good question. What do you say, David?
Well, I like bonds because they're much simpler than stocks in the sense of, and less risky than stocks. You're not going to lose 60% investing in investment grade bonds. Bonds are driven by math. And so if you want to know what the return for bonds will be, you can go pick up a bond fund, let's say BND, the Vanguard Total Bond Market ETF. They publish their yield to maturity. And if you back out the fees, it's called an SEC yield. And if you buy that bond fund and you hold it for 7 years, your return is going to be very close to that starting yield. You can't really say that with stocks. And so in the current environment, bonds are down 9%, that particular ETF, for example, because interest rates have gone up. But what that means is that bond manager, as this bond matures, the manager is reinvesting in higher yielding bonds. And so over time, those higher interest rates get reinvested, and your overall annualized return for bonds end up being the starting yield. And so 2 years ago or a year ago, looking at bonds, we knew what the return was going to be if we had a 7 to 10 year holding period. Where people make mistakes about bonds, or trying to get in and out and time the bond market. You own bonds for income and you own bonds for optionality, to have some dry powder for when something becomes more attractive. And one didn't have to hold the entire bond market like BND. Like, there were ways to invest in bonds that are less interest rate sensitive, that you're not down 9%.
Yeah.
You're only down 3 or 4%.
Well, for that matter, David, why not just buy the 3-year Treasury?
Well, you can buy the 3-year Treasury and hold that to maturity, and then you've definitely locked in your yield, which is, certainly an option.
And actually, this is one of the suggestions that I was going to make on this podcast too, was that, one of the things you can do if your bonds are falling, and obviously this horse has already left the barn, but you can shorten your maturities. And then you won't lose any money in the bond market. To me, and also, we have to acknowledge too that you can't get a hit from the dugout. So in other words, you're not going to get a home run in a 3-year Treasury either. But nonetheless, to preserve capital, you can shorten your maturities either by buying individual bonds, like I suggested with a 3-year Treasury, or by having a short-term ETF. So that's one thing you can do in a period of rising or falling bond prices, right?
And you can also own variable rate bonds. So one of the investments that I recently added is in what are called bank loans. So these are syndicated bank loans. They're non-investment grade, but their yields are tied to short-term interest rates. So when the Federal Reserve's raising rates, then their yields are going up. And so they yield 4.5%, 5% now. And you can lock in that return with an ETF that invests in bank loans or a mutual fund.
What's the symbol on that ETF? I didn't mean to put you on the spot.
I think it's BKLN. BKLN is how you invest in the entire leveraged loan market or bank loan market. A mutual fund that does it is the Sykes Floating Rate Income Fund, SAMBX. I invested through the BlackRock Debt Strategies Fund. That's a closed-end fund. The ticker's DSU, and I did it because it was selling at a 15% discount to its underlying value. And we don't necessarily have to get into closed-end funds, but there's different ways to do it. But you have to recognize the risk when you do that is if a recession hits, then the yields of those strategies will go up because the risk of default increases. And so you don't want to go investing in bank loans if you think the recession is coming in the next few months. But if you think it's several years out, then that's another option in the bond market that's variable rate that won't go down because interest rates are going up, and you can get a decent yield.
I really liked what you said early on in the podcast about you like the idea of investing in ETFs, but not necessarily all broad-based ETF, which leaves out a whole bunch of other potential things. So give me an idea, if you would, of the type of ETFs that you own personally or that you would advise people to take a look at in other sectors other than the S&P 500 index.
Right. So my approach to investing, I call it an asset garden approach. So you just want a wide variety of different return drivers in your portfolio, just like you have a wide variety of flowers or plants in a garden. And so one of the better performing ETFs I own is IVLU, which is the iShares, I think it's the MSCI Value ETF. IVLU is definitely the ticker. So this is a value-oriented fund, and it's global, non-US, and it's down about 6 or 7% year to date. But it's also, those stocks are getting cheaper and cheaper. So that's an example. One of the best performing stock, and you need to be careful with this one, is PFIX. It's a Simplify interest rate hedge ETF. And I talked about this on our website last fall. This is an ETF that actually protects against rising interest rates. And it does it through an option strategy, and it's incredibly volatile because of how it's structured, but it's up 65% year to date. So I added that to my portfolio, and I scaled the position so that it basically protected my bonds and preferred stocks from rising interest rates. And so, but again, you can't buy too much of it because it is so volatile. So that's another example. We own Japanese small cap, high dividend paying stocks. DFJ is the ticker. That's been more of a challenge because the yen has weakened so much. Yeah. But here's an ETF that has a price to earnings ratio of the underlying stocks of 7. You talked about buying like QQQ. It has a PE of over 30. So here we can buy an ETF in Japan, investing in smaller companies that tend to have higher earnings growth. The PE 7, the price to earnings ratio is 7, the dividend yield is 4 or over 4. And so I'll hold that. I mean, it's about 5% of my equity exposure, but it's just another diversifier, and you just kind of layer on. Diversifier is not trying to optimize your portfolio. We're just trying to cope as investors. We muddle through, and so there's some options to add to kind of diversify. If you just have one S&P 500 index fund, there is a whole world of asset classes out there that you can learn. And if you're only doing index fund investing anyway, you're not spending time researching individual stocks. So why not learn other asset classes and get smarter that way?
Where do you learn these things, David? How can our listeners go out and find those types of ETFs that you're describing here?
Well, you can learn them from money for the rest of us because we talk about them on our podcast on the website. But you can also, Morningstar is an incredible resource of free information on ETFs. Just Googling. I mean, if you want, it's like, I'd like to invest in small company Japanese stocks, and you Google it and it'll pull up a list of stocks, and then you just start reading about them. Or a list of ETFs.
I'd be remiss if I didn't ask you two other things before we end our podcast. And one is gold. What about gold?
I actually just sold some of my gold this morning. So I'm a long-term holder of gold. It's been a long-term inflation hedge. This year, it's not been a great inflation hedge at all. And so
it hasn't.
The risk with gold is when the dollar is strengthening, and when real rates are increasing, as they are, as the Fed raises rates, real rates will go up. That's not a good environment for gold. So I sold an ETF that had gold, mainly not because I think gold's going to fall, because I don't know, but there are so many other opportunities in this down market that I'd rather invest in something that's generating cash flow and has a very attractive dividend yield in this environment. So I just pared back my gold exposure, but it's still 5-6% of my net worth, and most of it in gold coins.
Cool. And then, of course, the last thing, Miranda knows I'm going to ask this: crypto. What about crypto?
Well,
yikes!
I sold half my Ethereum in January because it had gotten up to 3% of my net worth, and I realized, why am I wagering 3% of my net worth on basically a tech startup? And that's what it is when you're holding crypto tokens. They're competing with each other to see who's going to win. And so I have about 6-7% of my net worth in Bitcoin, or overall, in cryptocurrency, most of which is in Bitcoin. But I also have a lot of other smaller tokens which have gotten killed this year. But I use it, I buy a bunch of smaller ones just to learn about it because it's such a fascinating area. But to me, the simplest to understand, the first mover, the one with the simplest algorithm is Bitcoin. And so if one wants to speculate, and it is a speculation, definitely, Bitcoin is where you start.
Would you be a buyer today? Where are we? 30,000? Is that where we are?
Let's have a look.
Let's say there's 30,000. No, I don't. Like, I have enough Bitcoin. I sold Bitcoin last year, kind of in the 40s and upper 50s, because I wanted to own something real. We saw inflation coming. So I sold Bitcoin and we bought windows for our house made out of steel. Because they're real. And
those are definitely real.
Well, in the sense that it's 6% of my net worth with cryptocurrency. It was approaching 10%. It's sort of like, I don't know if this is going to work out or not. And it just seemed highly speculative. And with that and gold, it's like, I just took profits and we'll keep, the Bitcoin I have and just ride it out for the next century, I guess. And we'll see.
Cool. Yeah, we have to close pretty soon, but do you guys have any other questions? I've been dominating this whole conversation. So Aaron or Miranda, this is your opportunity to talk to someone who's obviously a genius.
Yeah,
well, okay, actually, so for those, go ahead.
Oh, I was just going to say, I just kind of wanted, along with that cryptocurrency thing, I too sold Bitcoin last year. So some of my Bitcoin last year. And so on my personal portfolio, I've made, like 50 times what I've put in for cryptocurrency because I did take profits last year. And so like David, I'm just kind of writing it out, but I think it's interesting to note that like cryptocurrency enthusiasts have been pushing this narrative that, this is an alternative to stocks and bonds. This is an alternative to the markets, the traditional markets. And what we're seeing is that cryptocurrencies are increasingly correlated to the stock market right now. And what we're seeing is it's not fulfilling this sort of decoupling promise we've been given. So I just kind of want to caution people, once again, like David said, this is a speculative investment. It can be kind of fun to play around with, but it's not probably going to end up being a hedge against the markets.
Plus, you probably had a very large tax bill after selling your Bitcoin last year. That was a shocker to us. So that's the other thing to keep me from selling more, is the taxes are too high on it.
Gosh, David, what a great guest you were.
Great,
really
thanks.
appreciate it. We are out of time, though, guys, but we are never out of topics, especially not this one. Dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is Miranda Marquit, MARQUIT.com. And, of course, you want to visit David at his website. David, tell me your website. I want to make sure we got it right.
Moneyfortherestofus.com.
Moneyfortherestofus.com. And listen to his podcast, guys. You're going to like it. If you got a question, comment, or topic you'd like to suggest, please tell us about it. You can email us at hello@moneytalksnews.com. That's hello@moneytalksnews.com. And one final thing, if you like what we do, then do something for us. Subscribe to our podcast. It takes you 2 seconds. Really helps us, though. So if you like us, show us and subscribe. I am Stacy Johnson.
I'm Miranda Marquit.
I'm feeling incremental.
And I'm David Stein.
Thanks again, David. Thanks for hanging out with us, everybody. We'll see you right here next time.